Welcome back to Kotak Insights, the podcast where we speak with leaders from India's top AMCs to understand the market outlook and investment trends. In today's episode, we're joined by Namrata Mittal, Chief Economist at SBI Mutual Fund. We discuss the economic forces influencing the markets, from India's growth trajectory to global inflation, interest rates, and the shifts happening across major economies.
Hi friends, welcome to another episode in our podcast series. And today we have Namrata Mittal, Chief Economist at SBI Mutual Fund. Welcome Namrata.
Thank you for having me.
So since you are the economist, I think today is going to be a little bit heavy episode. So we'll ask you a lot about what's the state of the economy about and both domestic and international, and what are the implications of that on the markets, both near term and medium term. So
I hope I'm able to explain that. Thank you.
Yeah, and we are in this nice conference room in SBI Mutual Fund's office in Mumbai. So right away, let me start with the state of the economy in India. Okay, and I'll just give you a little bit, what I am thinking currently, and then you can give your views. I think we have done a fabulous job on the inflation side, right? Inflation, in fact, wholesale inflation, people say is 1% or thereabout the handle. Retail CPI inflation is also less than 4%, which gives a lot of headroom to central bank to cut rates. Central bank RBI has cut rates already. Market is expecting another cut might be around the corner in the next policy, especially given that the Fed has also cut rates, right? So let's start with inflation and then we can go to growth. So little bit that how did we achieve this? Because India, if you remember, sometime back, maybe 10-15 years back, at least when I was studying, that we always used to be this high inflation economy, and we have done a structurally good job in containing inflation. How did this happen?
So there are multiple factors which can be attributed to it. So I remember back in FY 12-13, that is when on the retail front we were flirting with 10% sort of a CPI. Then 5 and 4 became the norm. Even right now, I think 4 and 5 is where we should be anchored for the medium term. But currently, the inflation is very benign. And this year's print could average closer to 2%. And in fact, the next latest print which will come, we are also wondering if it will be closer to 0 or 0.5%.
It's like 2% CPI inflation for the year.
Averaging for FY26. Wow. And WPI will be very close to 0, around 0.5. So there could be year-to-year nuances, but there are broader macro policy which is also played out both from the global front and from the domestic front. Let me first talk about domestic front. On the domestic front, we have adopted inflation targeting. Officially, we adopted this 2016. So whenever any few months we start to see inflation inch above 5.5% or 6%, central banks RBI becomes very itchy then you can take it for a given that the policy will be hawkish because that's their legal mandate. So that inflation targeting from the government side also, what we notice is that this current government, the NDA government, they will not give you, they're more supply side focused, they're more reform focused. You will not hear a lot of demand side support. Though, of course, we are talking about central state welfare schemes, but that was also happening with a broader mindset that the fiscal deficit for the state cannot shoot beyond 3%. So overall, the policy is such that, and even on instances when you see food go out of hand, we see very quick supply side actions. If I have to talk about crude, for example, since 2020, our retail prices on petrol and diesel have been very stable. They've been untouched. Their status quo for 3.5 years, barring a few cut in few states for VAT cut. And during this regime, your crude prices have been all over the place. It's gone from 120 to 90 to 60. So macro stable, policy has played a role. From the global angle as well, we are still in an era, though for US you can call it out a bit differently, where China is exporting deflation to rest of the world. Especially post 2019 when they've invested so much in their industrial capacity. I mean, you always fear in multiple sectors, whether it be lithium-ion batteries or solar modules or any other plastic toys or any other areas. We're always competing with China. Even right now, our import from China is rising despite the fact that we want to restrict it. And especially now that China still faces a 33% tariff from the US. So they are diversifying to rest of the world. So it's both global forces at play. Also, I should not miss
So
that.
I will just, for my easier understanding, what you are saying essentially is that China is creating such large overcapacity that they are kind of pushing all that produce in world markets, which are depressing.
They are causing global manufacturing deflation. And even otherwise, Chinese growth, their real estate is in trouble, because of which your global commodity prices are also continuing. You had a very brief period in 2022 when we had an onset of Russia-Ukraine war where global commodity prices went through the roof. But they have contained, they have been, they have...
And there's a secular trend kind of, because in most industries, China is creating mega capacity. They are still creating, by the way. So that is a global secular trend. Okay, so this is, a little bit what I understood, that our kind of government policies have been because they had to control fiscal deficit.
And I think I missed out one more point. Your consumer demand in India is not as robust, no matter what we say. So, especially on the retail inflation side, you find that the supply side competitive intensity is high, and there is a lack of robustness, especially post-COVID. So businesses do not have enough pricing power across most of the sectors.
Got it. So this was on inflation. I'll want to talk little bit about crude, but that I'll cover in the international section. Now let's talk about growth, right? Because we are participants in the equity markets, and large parts of earnings of companies at a macro level are a derivative of how GDP is performing, right? If GDP performs well, most of our domestic oriented companies at least will do well. If GDP is not doing well, but then obviously there's a concern on how earnings will grow, how balance sheets will expand. There's a lot of commentary on whether we are printing 6.5% to 7% range broadly, mota-moti of real GDP growth. It doesn't feel like a 7% growth economy. Any initial thoughts, any initial views on this?
Yes, I came across a very interesting research, and they put out the data in a very beautiful manner, which they said that between FY01 to FY13 and then between FY13 to now, our nominal growth was at least 3 to 4 percentage point higher back then. However, our real growth was between 6 to 6.5% even during those periods, and even right now. So what has happened, especially post the adoption of the new GDP series, we call it new, but it was adopted a decade ago. What we saw is that we work backwards. We look at a lot of MCA data, we arrive at EBITDA, we look at various the balance sheet variables, and then we work backwards by deflating it either by sub-CPI, WPI. Especially in periods of very low WPI, it tends to statistically distort the real numbers. So what that same study did was it compared various high frequency indicators, how they were doing in that decade up until FY13 and how they're doing now. So it feels like you're more aligned both on the volume terms or various value indicators. You're more aligned to nominal growth is a better reflection of where we are doing in terms of growth. and nominal growth was sub 10% last in FY25, I think 9.8%. And in FY26 also, we are staring at a possibility of 8.5 kind.
That is also a function of very low inflation, right?
Yes, I mean, from the equity market perspective, why you say that it doesn't feel like that? Because equity market reacts more closely to the nominal growth numbers. Okay. And I mean, you've seen, except for the COVID period, when nominal growth was low for FY20 and FY21, we have seen single-digit growth for India back in FY01 or FY02. Post that, even during GFC crisis, your real growth fell down, but your nominal was still in double digits. That is why, I mean, I do suspect that growth is a bit on the moderation side. You can also say that the global backdrop was a lot more different. I think the global growth was hovering closer to 4.5 to 5%. Today it's hovering 2.5, closer to 2.5 to 3%. So that has also got a role to play. Trade cycle has also got a role to play. But also our domestic thought process, we've become very ROE conscious. We've become very macro stability conscious.
Yeah, so much so that, the kind of deleveraging of corporate India's balance sheet that we have seen, I possibly haven't seen in the last 25 years, definitely, because all balance sheets, whether it is corporate balance sheet, bank balance sheet, is like spick and span. The flip side of that is people are not investing enough. Maybe corporates are not investing enough as much as they should. Once the private capex cycle kind of starts hitting, then that will be another lever to our GDP growth. But that is, unfortunately, it's happening in certain sectors. It's happening, but it's not as broad based as it used to be, like metals or whether oil and gas. Some of these big capex sectors, they are not investing as much.
So private sector wants to see the proof in top line. They want to see the revenue. I mean, I think nominal growth in India is sustained for above 11 or 12% for quarters, and they want to see top line also grow in double digit for quarters before they go on to invest, because they've just seen their balance sheet issues in the previous decade. So memory is still very ripe over there.
And you mentioned trade, so let me touch upon a little bit about trade. I think the biggest topic at the top of everyone's mind is what's happening with the trade negotiations with the US, which way tariff deal will happen, and what will be the shape and form, and which, while no one can guess, I want to pick your brain on the flip side, that this tariff negotiation, although is expected to close very soon, President Trump himself has said that we are very close to closing the negotiations. But let's say it continues for some time, okay? And right now we have seen specific sectors largely oriented to goods exports to US, which have got affected. But let's say, due to some reason, these negotiations take a little longer. Do you see that having a big impact on the economy?
Oh, absolutely. Okay. I think getting a deal with US is very critical for our overall growth, because over the last couple of years, especially since Trump's first presidency, as the US was diversifying away from China, the benefits were also incrementally flowing to India. We did a study wherein we found that the space that was vacated by China, some 15% of it was taken by India. So our trade share with US had risen over the last couple of years from 14% to 18% now. I mean, and in fact, in the first half, it was closer to 22% of our total exports were going to US. So exports form 20% of our GDP, and then exports to US form 20% of our total goods exports. So if the deal doesn't go through, I think what we heard by various interaction was that as long as the tariff was still 25%, the importers and exporters were ready to share the burden amongst themselves. But at 50%, we are even more disadvantaged now vis-a-vis China or Brazil. So to that extent, I do feel that our exports growth will languish, though the September print has suggested you otherwise, that between May to September 2025, India's export to US declined by 37 or 38 odd percent. But our overall exports grew on a YOY terms, which gave us some indication that there has been a diversification away to other market. Indian government is also exploring free trade agreements and bilateral investment treaties with multiple nations. But I think that ultimately US is consumer of the last resort.
Yeah.
And if 50% tariff is there, we might start to see it pinching.
And then there will be, first order effect will be the exporter companies which are kind of going to suffer or face the problems. Then the second order impact will be the employees of those companies. And the third order impact will be real estate sector where those employees would be possibly investing. Then the next effect can be with banks who have actually given loans to those employees or to those companies.
I suspect the kind of stimulus that we tried to provide with personal income tax reduction and your GST rate reduction, it had led to some sort of buoyancy in the consumer sentiment. But if this deal doesn't go through, we might soon start to test the job data and income data, especially for a lot of MSMEs and SMEs which are export oriented and they are labor intensive, like gems and jewelries, textiles, and even smartphones. We've seen a huge decline in smartphone export to US, despite the fact that it doesn't attract any duty. We've seen a fall in pharmaceutical. Pharmaceutical is out of the duty purview. So the positives of those might get negated if this is not solved through.
Okay. And which is, you're talking about almost a 3 lakh crore stimulus, 1 lakh crore in income tax and almost more than 2 lakh crore in GST.
Yes.
Okay. So it's a big one. Let's hope it gets done. One last point on domestic macro and then we'll go to international is current account deficit. I think again, like inflation, we have done a tremendously commendable job on containing our current account deficit. Again, if you go back to 2013, 12-13, when during taper tantrum time, our currency just went into a free fall because we were running a very, very large current account deficit. Now, most economists are kind of having a consensus that it is 1% or below is what our current account deficit is. If provided obviously oil behaves, it is in the $60-65 per barrel range. Do you think that is the case, that our current account deficit is now 1% or below centric?
Yeah, that is also because private investment is low. I mean, investment in the physical investment is equal to domestic savings plus current account. So our overall investment outlook.
So we are not importing stuff we are not importing machinery.
Plus there have been, I should not discredit anyone, but we have seen an improvement. So in terms of goods, for good long decade, I remember the entire decade of 2010 to 20, our annual exports number were always around $300 to $350 billion. Now we are closer to $450 billion. There has been some 15 to 20 basis point rise in goods trade market share. And there has been an even more handsome rise in the services exports.
Absolutely.
So that is where COVID has given us a push in terms of realizing that there can be remote working, work from home. And then India has a very strong diaspora of English-speaking people who are, we have a lot of good graduates also.
And the depth and breadth of talent pool available.
Yes, so something you must have all heard, GCC is flourishing. Our services exports, I think, if I'm not wrong, there's been growing, since COVID, they've been growing at a CAGR of 15 to 16%.
And within that also, now non-IT services are actually larger than IT services exports.
Plus what we've also did is that our Indians are now situated all across the world. So previously we used to get worried if crude prices will fall, our remittance money would fall. Of late, we are noticing that the remittance money is insulated to what is happening on the global crude prices.
Yeah, because it is getting diversified out of Middle East. It was
Even we have moved up the value chain on goods export also. We are increasingly lot of engineering goods, and we've moved up the value chain even in electronics, which is a very well-known story. Even in some of the aircraft's parts, we have moved up the value chain.
So actually, one of the things, and I was reading a report recently that crude oil imports, which used to be almost a little more than 5 to 5.5% of our GDP, that has come down to 3% of GDP. So that is giving you a big relief of almost 2 percentage points.
Perhaps that would be an early indication of the fact that we're trying to diversify to other sources of energy, which is also, and to give it all, your crude prices has also been sustained. I mean, it was a very brief period in 2022 when we saw crude prices hovering above $100 per barrel. But all the commodities have seen perform this year, but Brent is contained. Last year during Israel-Hamas war, we were worried about the impact on Brent, that was insulated. And I think it's in US policy interest also to keep energy prices contained because of the actions that they're taking on tariff front. So they want to ensure that the global cost of energy, so that is why, I mean, globally also we have sidestepped from how we were talking about renewable resources. So that is also helping.
Okay. So we'll go to global economy now, which is where more interesting stuff is happening. For India, boring is good. We are not doing anything flashy, so boring is good. And before I talk a little bit about the economy, we discussed a little bit on crude. The second most traded commodity, if I may say so, is gold. And, it has been one of the best performing asset classes of late. Although right now we are seeing little bit prices have come down, but still even after that it is one of the best performing asset classes. How do you see gold performing going forward?
Before we look at how it will perform going ahead, we have to also understand the reason why it did so well in last couple of years. And one of the most important reason for that, I mean, gold has given a good return for 3 years in succession. And even this year, the returns year to date are closer to 50%. So one of the, I mean, not for this year, but until last year, one of the important reason was that back in 2022, when US froze Russian FX reserves, and even in early this year, when there were trade disputes, there were tweets to freeze Colombian FX assets. So the central bank have started to diversify. And the annual, in fact, I mean, if you can go a bit more back in the history, in 1999, I mean, post the world, for 2 decades, the world was such a peaceful place that central banks were net seller of gold. And they came up, at least for the European countries, they came up with the Central Gold Act, where it was like a cartel, how you have Central Bank Gold Act, CBGA, like how you have for oil. In order to preserve the price of oil, you need to have production cuts. Similarly, these European central banks committed themselves in 1999 that they would not sell beyond a certain quantum. That expired in 2019, and over the last, even for India, our central bank holding of gold in quantity terms were, unmoved, even from global financial crisis till I think 2016-17. Then it inched up, and now we have bought, I think, 880 tons of gold. So, totally for global central banks all combined, for many years the annual buying used to be around 600 ton. That has increased to 1,000 to 1,200 ton. That was a structural force which led to increased buying. we're suspecting that this year we might not touch 1,000 ton because in the end, think about India. I mean, we have 15% of our, few years ago, we had 6% of our reserves in gold. We have now 15 to 16%, and every day it's changing because of the valuation reasons. But in the end, you need your other currencies to manage the balance of payment fluctuations.
Yeah.
And I mean, previously there were studies which said that 15% of reserves is fine. Poland is one of the biggest buyer of gold. They had initially agreed to take their reserves up to 20% in terms of gold. Now they've taken board approval to increase it to 30%. So that was the reason, sort of an anti-US trade or diversifying away from the holding of US treasuries.
De-dollarization.
Yeah, a gradual de-dollarization is a term. But now what you've seen is that for last couple of years, Western ETF were not the game in town. They had missed this entire rally on gold. And now they are back. I mean, for last couple of quarters, this year, their buying has increased substantially. But what it tells you that going forward, there could be much more volatility in gold prices because the ETFs would, whenever you see them increase their participation, that's when there is much more volatility. But from a very medium-term perspective, as long as you're worried about US fiscal largesse or their monetary policy independence, I think, investors would always want to have gold in their portfolio.
Okay. So, I'll not ask you what your target price on gold is.
Nobody knows.
That no one knows. Okay, so let's talk about little bit about the US economy. Okay, and and I don't know how it has happened, and I don't know whether anyone would have imagined that on the inflation front, tables have completely reversed, and we are looking at, as you said, close to 0% wholesale inflation, less than or about 2% annual retail inflation in India. US raging inflation for the last 3 years, although Fed has cut rates in its last policy, but this anchoring of inflationary expectations is not happening in US. So what are your thoughts about that?
So, US central bank target is central bank target score PC, that is around 2%. And the inflation in US has been higher than expected post-COVID. First, they thought that it was a transient inflation, but it seems to be more permanent in nature. Every time the reasons were different. First, it was the supply side problems right after COVID. Then there was ultra loose monetary and fiscal policy. And for a very long time, it was the ultra loose fiscal policy. I think right after COVID, US had the checks getting hand out to the US consumers, and which led to, and apart from that, so it led to the savings which were over and above their trend. So there was a demand side inflation. Presently, it is tariff. I think there has been very recently.
Okay, so because US is increasing tariffs, so everything which is landing in US is much more expensive now.
Yes, very recently there has been a Harvard study which has come out, which says that the entire impact of tariff has been borne by US importers and US consumers. Exporters have been more or less insulated, and currently US CPI is closer to 3%. Had these tariffs not been there, it would have been 70 basis point lower, closer to 2.3, which is like very close to their target.
But just, help me understand, Namrata. You say that their targeted inflation is about 2%, and right now it is kind of trending much above that. Still, why would then Fed cut rates?
Yeah, so unlike India, where we have inflation as a mandate, in US both employment and inflation is a they have a dual mandate.
Okay.
And labor market data has been soft. In fact, a few years ago, I thought that if there's one indicator which I have to watch for a sign of recession in the US, apart from all those inverted yield curve and so forth, I'll watch for non-farm payroll.
Yeah.
And the moment your non-farm payroll is below 50,000 for good 5 to 6 months, historically that has been an indicator of recession. Now you all know all the indicators which have worked in the past as a signal of recession is out in the garbage. I mean, nothing is working in terms of economic modeling. So
Which means you have to work harder now.
that means we are still in job. Yes. So there are both supply side issue. I mean, Trump's current policies have been very strict on immigration. So that has also led to the fall in labor supply. Right now, the hiring intentions are falling. The quits rate are not falling as yet. But I think the first 25 basis point of cut that we got very recently from US Fed was a response to the softer labor market data. However, currently market is projecting that over next 1 year, you could have an additional 100 basis point of cut.
Oh, wow.
Neither has Powell's commentary suggested that, nor do macro fundamentals in the US tell you that this 100 basis point of cut is a given. It will only happen if you see greater troubles in US equity markets, especially with regards to what is happening in the technology sector over there.
It is a very interesting trend on how, and it has been the case since actually pre 2000. I think it was as a response to the dot-com bust that Alan Greenspan, there was this famous Greenspan put to markets, that how equity market actions actually influence US Fed decisions, because wherever there is a kind of a dip or a crash or correction in the equity markets, suddenly all eyes are on the Fed that please bail us out.
Yes, it seems like Fed put is still alive, but right now what you're noticing is that Fed has responded in terms of reducing rates even when US is not in recession. And historically, if you go back and see the periods when, I mean, in 97, 98, 2007, 8 and 2019, and there are a few more periods when Fed has responded to rate reduction, irrespective, I mean, even when there is no growth, meaningful growth recession in the US, it doesn't work that well for US dollar. It doesn't work that well for US assets per se. And there is also an underlying projection every now and then that is Fed's independence getting undermined because of the way the seats.
There's a lot of pressure on the Fed.
But I'm not too sure if those were the reasons to deliver these 250 basis point of cut. But perhaps one of the reason why market might be penciling 100 basis point could also be because I think Powell's term ends somewhere next year. Yeah. So maybe that may also be one of the factors playing in investors' mind.
Okay. And in any case, large part of US market returns today are driven by AI. So I mean, recently I read a very nice article by Mr. Ruchir Sharma that US is now a one-way bet on AI. So whatever happens to AI will determine, and whether it is Mag 7, whether it is how NVIDIA is performing, or whether it is all these private companies like OpenAI, their fabulous valuations that they are commanding. So in some sense, how much of the returns of equity markets are being derived out of the real sector, most of it is actually happening through the AI sector. So we'll need another episode to talk just about AI, so I'll not touch upon that a little bit. But you're right that if something happens there and there is a meaningful correction in equity markets, then in any case...
Increasingly, market has started to question that. For example, previously, Then I just followed. I mean, if you read through, you find that previously when Meta used to announce their expansion, more capex, market used to reward the stocks. But now when they announce of expansion, market gets more skeptical. There are data all around. Bubble is very difficult to call, very difficult to time. I mean, you've seen it all around, even in dot-com bubble. There were people who were calling it for...
Like from 98, people started.
Yes,
Actually, it took
yes.
2.5 years.
Yet, they made very good returns
Yeah.
by being invested in 99.
Yeah.
So,
Yeah.
it's...
Yeah, so actually, bubbles and returns again are two different things. How you time the market,
But by the way, for India, we are increasingly getting seen as an
anti-AI
anti-AI
play.
play. Yes.
No, so I was having a discussion on this topic with someone, and the thing is that when AI is working, we are not getting flows because all the flows are going to AI plays. When let's say if AI corrects, then anyway the entire global markets will be in a shock that we might not get flows. So thoda sa it is worst of both worlds right now for Indian market. But luckily, I think the good thing which I at least feel right now is about Indian equities is we've seen almost a 15-month period of sideways market. So there has been a decent time correction. Earnings are on the way back. And
Policy has also become more growth
more benign.
focused.
Yeah.
I hope, I mean, though there, I hope it stays on that path because
and
growth
policy-
needs more hand-holding.
Yes, we just had a big bonanza from GST rationalization. So policy is also right that it is becoming more good because and this also shows that possibly the policy makers are much more confident on inflation now. That let's say there are
Inflation has provided you a very healthy enabling backdrop to stay focused on growth. Though I think now the fiscal, I mean, we'll have to be a lot more focused on the tax buoyancy to see if the government's focus on growth support can continue even into the coming years.
Okay, so I think we are at time. So on this happy note, hopefully government will keep on giving more stimulus to the economy, which will reflect in better equity market returns, which will reflect in better portfolio returns for our investors. So very nice catching up, Namrata, and
Thank you.
possibly we'll meet again just to talk about AI.
Thank you. Pleasure is all mine.
Yeah.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.